Up until now, we've only been talking about technical aspects of production or the cost of production. What we haven't dealt with was how firms decide how much to produce from an economic point of view. In order to do this, we need to understand something about how firms respond to the prices that they face for the goods that they're producing. This is about competitive firms in markets and how competitive firms operate within markets. It also leads us to one of the core concepts of this course, which is the notion of a supply curve. This material is drawn from Chapter 8 of the textbook.
Now, before we talk about firms and their supply, we need to make clear that we're making an assumption of perfect competition. This is one of the core tenets of economic analysis of most markets. And the assumption of perfect competition carries with it a number of detailed assumptions that are important to note here. All of these assumptions can be relaxed, and indeed later in the course we'll see how we can relax some of those assumptions and what the consequences are of actually moving away from the perfect competition assumption. One of the assumptions underlying perfect competition is that goods produced by firms are homogeneous. That is to say, they're identical in every respect. And the notion here is that 2% milk produced by one dairy processing company is identical to 2% milk produced by another dairy processing company. Another assumption that's very important in what we're going to do is that firms can enter or exit the market without cost. This is the so-called free entry and free exit assumption. Very often in introductory micro and intermediate micro courses, you'll hear people only talk about free entry. But it's also important to recognize that there's this notion of free exit. In some circumstances, exit may not be free. Choosing to leave an industry may carry with it a cost. We're also assuming that there's no risk or uncertainty. This is actually a more difficult assumption to relax, but in a couple of weeks we'll show how firms might make decisions if they face risk and or uncertainty when they're choosing how much output to produce or how much input to use. We're also assuming that price is known. And this may seem like a bit of a silly assumption, but really what we're getting at is that the firm knows the price or at least has an idea of what that price will be. That is to say, they might have a price expectation, and that price expectation is what they react to when they're deciding how much to produce. Two other assumptions are that there's low or no cost to searching out a buyer or seller, and that there are no externalities. The no or low cost of searching out a buyer means that it's not expensive to actually go out and find someone from which to buy a good that you're looking for, or someone to sell your good to. The no externalities assumption simply means that the actions of other firms doesn't bear a cost or a benefit onto you directly. The externality story is actually one that's quite important when we're dealing with the market for environmental goods or services, and we'll talk about those near the end of the course. Now, really what we're getting at in making this perfect competition assumption is that firms behave as though they're taking the price as fixed and given. This is often called price-taking behavior. And the idea here is that each firm is so small relative to the size of the overall market that no matter how much that firm produces, its production decisions will not influence price. We can also take this price-taking behavior when we're dealing with the market for inputs. But since we're talking about output here, let's just think about it in those contexts for the time being. So to be clear, firms are assumed to be price takers. No matter how much a firm produces, it cannot influence price. And again, I want to emphasize, we will relax this assumption later in the course because it is an assumption that some have started to question in a number of agricultural and food markets. Now, we're talking about how does a firm decide how much to produce. And I think it's important to recognize that there's different objectives that firms will pursue when they're deciding how much to produce. Up till now, we've been focusing on the least cost approach to choosing the inputs that the firm's going to use. We're going to switch gears here and actually say, okay, if the firm is going to earn revenue and bear costs, how does it choose how much to produce? Well, it's going to do so by trying to maximize profit. And we're going to look at profit maximization in the short run. That is to say, when there's certain fixed and variable inputs to production. Now, profit, to be clear, is defined as revenue minus costs. Revenue, which we'll talk about in a few minutes, is relatively straightforward to conceptualize. Costs, as I indicated in lecture a couple of times, are actually a little more difficult to conceptualize because it depends on whether or not we're talking about economic costs or business costs or accounting costs. To an economist, the costs that are relevant reflect not just the the external or the out-of-pocket expenses, but also the implicit costs associated with using resources in a particular activity. That is to say, it reflects opportunity cost. Now, we've spent a lot of time talking about these costs, and I don't want to belabor the point. So let's move on to revenue. And revenue is simply the returns generated by the firm when it sells an output. It's how much they earn from selling output to consumers. And it's simply the price of the product times the level of output of that product. Now, we can do a lot with revenue. In fact, we can calculate what's called average revenue. And this is simply the revenue, the total revenue, per unit of output. And all we do is we calculate total revenue divided by output. But since total revenue is equal to price times output, the numerator in the box I've just highlighted includes output, but so does the denominator. And the output in the numerator and output in the denominator cancel, and what we're left with is that average revenue for a price-taking firm is equal to price. If the firm isn't a price-taking firm, the circumstances will change. We can also think about marginal revenue. And marginal revenue is simply the change in revenue from producing more output. And so it's the ratio of the change in revenue divided by the change in output. But because the firm is a price taker, the change in revenue has the same price component in it regardless of the level of output. If we factor price out of that change in revenue term in the numerator, what we end up with is price times the change in output, all divided by the change in output. The change in output will cancel in the numerator and the denominator, and what we're left with is that marginal revenue equals price. Now, I want to emphasize this is because the firm is a price taker. And because it's a price taker, the price does not vary as the firm varies its output. So even as there's a change in output by an individual firm, there's going to be no change in price. So to recap, price is equal to average revenue, and that's equal to marginal revenue for a price-taking firm. So we have enough information now to actually move on to think about how firms choose the profit-maximizing level of output. And what they're trying to do is make the difference between revenue and cost as large as possible. So what the firm is going to do is they're going to continue to expand their production as long as the increase in revenue from selling another unit of output is greater than the increase in costs from producing another unit of output. This leads to two very important questions, and in fact they're the kernel of today's video. One question is, what level of output maximizes profit? And this is getting at what an economist would call an optimal output decision, where by optimal we're talking about profit maximization. What's the profit maximizing level of output? The second big question that we're going to focus on is, does it ever make sense not to produce? Because it's sometimes the case that firms actually want to exit from an industry or choose not to produce in a given year. This is defined by what's called the shutdown point or the shutdown decision. That's the second main component of what we're going to talk about today. Now, to get at all of this, you're going to need to know how a firm would decide at what level of output to produce. And to get at that, I'm going to use a figure that's included in the notes. In particular, on page 3 of the diagram, you should see a setup for a figure that looks like this. You're going to have to write what is represented on the axes. So on the x-axis of both of these diagrams is output. On the top panel, the y-axis is total revenue or total costs. And on the bottom panel, the y-axis is represented by profit. You might want to pause the video for a minute here just to jot down those as we're going to move fairly quickly through how we use these diagrams. Now, to use these diagrams, what we're going to do is actually plot total revenue and total cost on the top, and then the profit associated with total revenue and total cost on the bottom. Total cost is going to be represented by this red line. This looks very much like the total cost curve that we've looked at in the previous section of the course. Total revenue is going to be this green line. Notice that it goes through the intercept, and what it says is that if the firm doesn't have any sales or any output, it's not going to receive any revenue. And total revenue is simply price times quantity, where quantity is the level of output. So I want you to note that price is in this term. And so it's actually price times output, and since we're measuring dollars on the y-axis versus output on the x-axis, the slope of that green line is actually the price. It's the price, the marginal revenue or the average revenue that the firm will receive from selling a unit of output. Now, the gap between revenue and cost is what we're interested in. I've highlighted a region just here where total cost is above total revenue. And what you might think of is that that's a bad place to produce. And in fact, if that's what you thought, you're right, because you're spending more on your outputs than you're earning, and so you're going to lose money. You don't want to do that. Most people who are in business don't like losing money. They want to be in business to earn money. So really what you want to be thinking about is producing somewhere in the region that I just highlighted with this arrow. Somewhere where total revenue is greater than total cost. And the gap between total revenue and total cost is profit. And what we want to do is find a level of output that makes profit the highest. Now, to put some sense on this, I've actually drawn in the bottom panel a black line. That black line is the profit associated with the total revenue and total cost curve shown above. And what the firm wants to do is figure out the point at the level of output that gets it to the highest peak of that total profit curve on the bottom panel. Now, if you look at it, you would think that a firm would want to produce at Q star units of output. And indeed, that's where the firm would want to produce, because that's the level of output that's going to maximize profit. Now, there's a couple of things that are true about total cost and total revenue at Q star units of output. One thing that's important is that the slope of the total cost curve at the profit maximizing level of output is equal to marginal cost. And so I've drawn a blue tangent line on the red curve at Q star units of output. And that's simply the slope of total cost, which is, as we know from the previous section of the course, marginal cost. Now, at Q star units of output, what you might be thinking about in looking at this diagram is that the slope of total costs looks very much like the slope of total revenue. And indeed, that's the case. Indeed, it's the case that at Q star units level of output, marginal cost equals marginal revenue. That is to say, the slope of the total revenue curve equals the slope of the total cost curve, but at Q star units of output. So when a firm is maximizing profit, what they're really doing is trying to find a level of output such that their marginal revenue is equal to their marginal cost at that level of output. Now, that's all done in terms of total revenue and total cost. We can also look at this through a different lens. We can think about it in terms of marginal revenue, marginal cost, average variable cost, and average cost. Page 4 of the notes has a diagram that looks something like this, and you're going to be able to draw in the few figures that I'm going to go through in the next few minutes. Again, you may want to pause the video and write in on the notes what each axis is labeled as. Now, what I want to get at here is that let's just suppose that the red line shown here is the average cost associated with the total cost curve on the previous slide. Marginal cost is the marginal cost curve associated with that total cost curve, and the price is given by this green line. That is to say, the green line shows the price that the market will bear, which is also average revenue, which is also marginal revenue. What the firm is going to do is it's going to try to maximize profit. It wants to find that level of output where the peak of, or where you're at the highest point of the profit curve shown in the bottom panel. And just to reiterate, that happens at Q star units of output. Now, what's true is that when we draw this diagram in terms of marginal cost, marginal revenue, and our average revenue in the top, we're going to end up seeing that the firm's profit maximizing level of output occurs at the point where marginal revenue is equal to the marginal cost curve. That is the point where the green line intersects with the purple line. That's not by accident. That actually has to happen if this is a profit maximizing level of output. And all it represents is the fact that the slope of total revenue is equal to the slope of total cost in the previous diagram. So really what we're getting at is that we can go from one diagram to the other. We could look at the profit maximizing decision in the context of this diagram, or we could think about the profit maximizing decision of the firm in the context of total revenue and total costs. We should get identical answers in terms of the optimal level of output, regardless of what approach we take. So what we've done is we've actually answered the very first question, and that is, how does a firm decide what is the optimal level of output? And what we've shown is that a firm maximizes its profits by producing at the level of output where marginal revenue equals marginal cost. This is a very, very important point. You have to know this. I want you to know this. And what we're saying also is that since for a competitive price-taking firm, marginal revenue equals price, then it's the case that the profit-maximizing firm chooses a level of output such that the marginal cost of producing at that level of output exactly equals price. This gives us one of the most foundational equations that we use in economics, and it's that a profit-maximizing firm chooses its level of production where price equals marginal cost. Now I want to emphasize, this is for a price-taking firm. If the firm is not a price taker, this rule becomes subtly different, and we will talk about that later in the course. But I want you to be able to use this condition in a variety of circumstances throughout this course, and I want it to be one that you remember, because it's getting at the idea that when you sell that last unit of input, the price that you get, if you're profit maximizing, should equal the cost associated with producing that last unit of output. That is to say, price should equal the marginal cost from the last unit of output. Now that might be a lot to absorb, and so you may want to go back and review that and take a look at the notes and at the textbook. But what I'd like to do now is actually move on to the other issue that we have to deal with when we're talking about the supply of a firm, and that's the shutdown decision. And so what I've done here is I've drawn the diagram from the previous slide all over again. You have space in your notes, I believe, to actually draw this as well, and you may want to pause the video to draw this in the way that I have, making sure that you've got marginal cost cutting through the minimum of average cost, and draw it so that the marginal revenue curve intersects the marginal cost curve well above the minimum of the average cost curve. Because what we're going to do is we're going to use this diagram to talk about shutdown decisions. And to get at shutdown decisions, you need to understand something about what's called the break-even point. A break-even point is the point where the firm isn't earning any more profits. Their profits are equal to zero. And what's happening at that point is that average revenue equals average cost. And so what you might think about is, well, when does that occur? Well, that occurs when the price that you're going to receive in the marketplace is exactly equal to the minimum of the average total cost curve. When that happens, the reduction in that price will actually push the profit curve in the bottom panel down. It will push it down to the point where the very peak of the profit curve is just touching the zero axis, or the output axis in the bottom panel. And what will happen is that the firm will choose to produce Q star units of output. Now, they're still producing where price equals marginal cost. It's just that they're now producing given a break-even price. The profits that they're earning at this break-even price just equal zero. They're not making a loss. They're not making profits greater than zero. They're exactly breaking even. Now, that actually has some important connotations, because what you have to think about is, what would happen if the price fell below that break-even price? Would the firm still continue to produce? Well, we know actually that if the price falls below the minimum of the average total cost curve, that revenue is going to be less than average total cost. If total revenue is less than total cost, then the firm is making a loss. But it may actually be that in the short run, the firm might continue to produce. Now, pause to think for a minute. Why would a firm choose to produce if it's losing money in the short run? Well, there's a couple of reasons why that might happen. In fact, there's one that really stands out in economics, and that's this notion of a shutdown decision. And the idea here is that if the firm stops production, it still has to pay its fixed costs in the short run. And so the choices are thus. It could either produce nothing at all and still pay its fixed costs, or it could produce and use revenue to pay for variable costs and some of its fixed costs. The notion here is that if you can't make a profit, if price is below the break-even price, and if you can't make a profit, that the best course of action is to actually minimize the loss associated with the decisions that you're making. So you're able to pay your variable costs and some of your fixed costs. Now we can illustrate this graphically, actually, and what we're going to do is we're going to illustrate what's called the shutdown decision. Page 5 of the notes has space for you to draw the diagram that looks like this. We're going to draw an average cost curve labeled AC. We're going to draw an average variable cost curve labeled AVC, and we're going to draw a marginal cost curve labeled MC. The shutdown point is the point at which average variable costs are minimized. In the short run, that's an important point. In the short run, the shutdown point is the minimum of the average variable cost curve, right there. And the idea is that if price is anywhere above that shutdown point, the firm would still choose to produce. And the reason why it would still choose to produce in the short run is that because it is still able to cover all of its variable costs, and it's also able to cover some of its fixed costs. Now, of course, if price were above the minimum of the average cost curve, the firm is making profit, and all of this is a moot point. They're still making profit. But if the price is below the minimum of the average cost curve and the shutdown point, the firm would still choose to produce exactly because of what I just said. They can still cover their variable costs, but they can now cover a portion of their fixed costs. Now they're losing money, but they're not actually losing as much as they might possibly. For instance, if the price were less than the shutdown point, the firm would actually want to shut down because it can't even pay its variable costs anymore. So if we had a price that looked like this, the firm would still choose to produce because it's still covering all of its variable costs, and the revenue is contributing a little bit to cover its fixed costs. It can't cover all of its fixed costs, but it can cover some of them. If the price were to fall to something like this, the firm would choose to shut down because it can't even pay for its variable costs. If you can't pay for your variable costs, it doesn't matter how badly you want to produce, no one's going to sell anything to you because you don't have the revenue to pay them. You can't afford to buy the inputs into your production process. So the shutdown point is a very, very important point. And in fact, it's important not just because it tells us something about when it is and isn't rational to choose to continue to produce. It also helps us in defining what we call the firm supply curve. The firm supply curve becomes very important because it then leads to what we call a market supply curve. So the firm supply curve is simply the amount a firm would be willing to produce at different prices. And in the short run, it's the portion of the firm's marginal cost curve above the minimum of the average variable cost curve. That is, it's the portion of marginal cost above the shutdown point. But I want to emphasize it also includes a portion of the price axis below the shutdown point. Now that's a little bit complicated, so let's illustrate it with the diagram. And again, there should be space on page 6 of the notes for you to draw this. I'll give you a minute to draw it, or you might want to pause the video so you can draw this diagram in the way that I have. Now what I'm going to do is I'm going to first put our shutdown point here. That black dot represents the point at which it doesn't make any sense for the firm to produce. So if price is below that black dot, the firm would rationally choose to stop production. But if price were anywhere above that black dot, the firm would choose to produce, and it would choose to produce at the point where price equals marginal cost. What that means is that the firm would then have the following supply curve. At any price below that blue dotted line that I've drawn, that is below the shutdown point, the dark shaded portion of the price axis below that blue dotted line represents part of the firm's supply curve. At any price below that, it makes sense not to supply. So your quantity supplied would equal 0. That's why I've shaded that part of the price axis. At any price above the shutdown point, you would choose to produce somewhere along the black shaded part of the marginal cost curve. And the reason why it's the black shaded part of the marginal cost curve is that we know that a profit maximizing firm that's a price taker chooses a level of output where price equals marginal cost. So if price were given by this line, what the firm would do is it would choose a level of output where the green line intersects with its supply curve, with that black part of the supply curve that goes along the marginal cost curve, and it would have Q star units of output. If price were higher than this, the firm would rationally choose to increase its output, and in fact it would choose a higher level of output somewhere along the marginal cost curve that intersects at that higher new price. If price were lower than this but still above the shutdown point, the firm would rationally choose to reduce its level of output, and it would choose a lower level of output such that price equals marginal cost. This is a good place to stop now.